do not buy the dip. But let me clarify that real quick before, don't buy the first dip, right? We all know, we've all lived through this meme where you buy the dip and then another one comes and you buy it again. And you're like, shit, I'm out of money. Then the real dip comes. The big dip is always around the corner. Like, you know this. It's never that like right away in your face. It's always around the corner. And it happens when you think a recovery is about to happen or something, right? Now, I'm not saying this is going to be a terrible year in the market. I'm just saying intra-year, I think there will be a bigger than average drawdown. And I'm going to show you 3 charts that probably going to make you feel better, because I don't want to start the video doom posting or doom talking about how there's going to be this great correction. I just think there's going to be at least 1 month in the next 12 months that's going to make for really, really, really good buying opportunities. But again, I'm trying to give you confidence in this video. So these 3 charts should help you feel way better, right? So why do you hear people say being a perma bull is the way to go? Permanent bull, for those that don't know what I'm saying. Because the data shows it, right? Looking at this, we'll start with this chart right here. The S&P 500 index, for those of you that don't know, that is a basket of the top 500 companies in the world, basically, that are listed on the stock exchange. So going back to 1948, call it like 75 years-ish of data. Here's a couple interesting things that we notice about this chart. First of all, here's how to read it, right? You got the year, 1948. DD stands for drawdown, but this is intra-year drawdown. So maybe it happened in May or June, or maybe in September, right? The big drawdown, or maybe it happened from May to September, but that's just intra-year. That's not January 1st to December 31st. TR, total return, that is the total return from January 1st to December 31st of that calendar year, right? So drawdown is the biggest drawdown during that year, whenever it happened in between January and December. Total return is that calendar year, January to December. What is the total return? Okay. So that's how we read it. And this is kind of giving you a perspective on the average drawdown that we see every single year. And most people probably don't even know, right? It kind of surprised me because I never really thought about it, but 100% of the times, every single year going back to 1948, there is a drawdown that happens, right? The market doesn't only go up. It doesn't only go down. It's a roller coaster, but it's like a man playing with a yo-yo walking up an infinite staircase. In the end, it always goes up. But check this out. On average, you pick any of these years, the average intra-year drawdown is like 13%, which is pretty big, right? That's a big drawdown for the S&P 500 at least. But around 80% of them, right? 100% of them, they're going to see red. Every year, no matter what, you're going to see red at some point. But 80% of them are going to end up green, 80% of those years. So like, yeah, being a permanent bull makes sense because, I mean, just market goes up. It's a great Ponzi. It's a great Ponzi that's been created. What I want to showcase here is, all right, let's just look at the facts, right? Look at the stats. So the probability, for those of you that are always scared about like, oh, I'm going to sit out because things are not looking great, recession could happen, there's always excuses. In 2022, it was like we're going to go into hyperinflation and the USA is going to crumble. 2025, it's tariffs are going to kill us. The price of everything is going to go up incredibly. Businesses, their margins are going to shrink. Recession, all that, right? There's always an excuse. But when you see those headlines, think of this chart and think of these stats. So the probability of 2 consecutive declines occurring is lower than 3%. So 2.67% is the probability of having 2 red years back to back. That's really low. That's basically like 98% chance that that's not going to happen, right? So 2% chance that you're going to get 2 negative return years in a row. I'll take those odds like all day, any day. And the next one, the probability of 3 consecutive down years, which is really bad, is 1.3%. So the only one on here of 3 consecutive total return years is the dot-com bubble when it burst. But that's because if you look before the year 2000, look what happened. Starting in 1995, markets up 37%. Next year, up 23. Next year, up 33. Next year, up 28. Next year, up 21%. That's insane. I always keep telling people, like, I wish I wasn't a baby at this, or a toddler in the 90s, because what a run. But of course, overheated, you must pay the price. And They paid the price with 3 years of negative consecutive returns, but the odds of that, very low. Next chart that I want to pull up is S&P 500 worst performance through the first 48 trading days. So right now we're in late March in 2025, which is about 50 trading days so far in the year, right? Obviously not counting weekends and any holidays we might have had. There's been about 50 trading days. So where do we rank? Because the market is down a little bit. Where do we rank when we compare every other year in its first 50 or 48 trading days and how it performed, right? So the number one spot is after the Great Recession of '08. The first 48 trading days. And by the way, this is a very like cherry pick time frame, I know, but it's just gauging where we are today. So yeah. 2009 had the worst first 48 trading days, about 17% down. And then COVID makes sense because this is around the time in 2020 when all of us got locked down. Crazy year. And then number 4 is actually more recent, 2022. That was a bad year. Yeah, that was a really bad year for stocks, but it was great opportunities. I made really good money from the little money that I started out with. And today we are at number 18, right? So being down 6% in the first 48 trading days is not a red flag indicator or recession indicator or bear market indicator. It's just like number 18. It's not ideal, but it's not something that you should be too worried about. Now, what could happen tomorrow or 3 months from now or 8 months from now? We don't know. Like we could go into a recession. Anything is possible, but just ranking it on where we fall compared to other years. Number 18 is not bad. I'll take it. All right, chart number 3. This one is a little more interesting, maybe not so like, it's not ingrained in facts, but we could just make some interesting observations. The blue line is the S&P 500 price chart dating back to 2019 to present day. This black, very like unhinged line is put volume for options. So puts are essentially, if you're buying a put, you're betting against the market. So you're only making money when the market or a specific company is going down in price. And it makes sense that basically the chart here is saying when put volume, when people are betting against the market or companies, when that volume gets to all-time highs, it's usually when the market has bottomed. And it makes sense because on the inverse, right, when everybody's bullish and buying calls, then the market probably is a little frothy. So essentially, I saw this on Twitter. What it was saying was when put volume makes spikes to new all-time highs, that's usually like the bottom or at least local bottom. So I counted like the spike, like the really big spike all-time highs dating back to 2019. 5 of the 6 that I counted were actually marking bottoms. So let's look at March 2023 was the most recent one right here. And yeah, you could say that is a really well-timed bottom, right? It lines up because the S&P just went up from there. And then before that was, I believe, September 2022. So the tail end of September. And that also lines up. After that, it was a nice ride up. Bumpy ride, but it was a ride up. And then this is the one exception here in 2022, the beginning, which is like when the war with Russia, Ukraine started and all that started tumbling down. So this was the exception, but everything else basically lines up with printing new bottoms as far as like put volume spiking, right? Even this one aligns really well with the big drop off here during COVID. Because like when you think about it, when everybody is hip to it, when everybody has the confidence to short the market, probably means like it's too late to short the market and things are reversing. So it's interesting. This is a chart that I already had up here on the side. I'm not sure if you guys were reading along. Just remember this chart, I think is probably the most important to remember because the odds of, a lot of people, when the market does turn red on any given year, they start to find all the excuses. But in reality, it's never as good as it seems. It's never as bad as it seems. Look at this chart, save it, remember it. And most importantly, try to recall when those times are happening that every single year in history has had a drawdown. And on average, that drawdown is double digits. But most of them, even like look at 1997, right? Of course, this is a dot-com bubble, but even then they had a 10% drawdown, a 19% drawdown, a 12% drawdown. And look at the total return for that year, 23, 33, 28, 21. Look at 2003. 14% drawdown, but the year ended up almost 30%. So I'm gonna leave you guys with that. And on that note, and reminder to not push all your chips in. Don't buy the first dip, maybe the second or third, but the way to actually play this is not by counting them, it's by counting the amount that the S&P is down, right? So if SPY is down 10% in a month, yeah, it's probably doesn't matter if it's the first, second, third, or fourth, you're buying that dip.